Good evening. Have you done the homework? 21, 1 mark question. Check the answer. See how many of this you have got it right. Property, plant, equipment. Neither financial asset nor financial liability. Intangible asset, not a financial asset. Investment property, not a financial asset. Capital work in progress, not a financial asset. Investment property, not a financial asset. Creditor, financial liability. Bills payable, financial liability. Bills receivable, financial asset. Investment in equity share, financial asset. Security deposit from customer, financial liability, because you have to repay it back in cash. Obligation to pay in cash. Then loans and advances, for one party financial asset and for the other party financial liability. So even if you have written only one, I will give you mark. Preference share redeemable, liability. Advance for supply of goods, not a financial asset. Advance from customer for supply of goods, not a financial liability. Warranty provision, not a financial liability, because this is not going to be paid in cash, it will be in the form of service. Provision for tax, statutory obligation, so not a financial liability. Deferred revenue, not a financial liability, no obligation to pay cash. Inventory, not a financial asset, because there is no obligation to pay cash or another financial asset. Cash and bank, by definition, financial asset. Investment in debentures and bonds, financial asset. Gold, not a financial asset. And security deposit to landlord, financial asset. Financial asset. Security deposit to landlord, financial asset. Okay, because once your commitment is over, you will get the cash back. So it's a contractual right to receive cash. Contractual right to receive cash. So this was part 1 of this chapter. Basic understanding of financial asset, financial liability and equity. So today almost 1.5 hours we'll be spending now with compound instrument. So what is a compound instrument? A compound instrument is an instrument which has features of both debt also and equity also. That means this instrument is not only debt, it is not only equity, it is a combination of debt and equity. Like for example, a convertible bond. So suppose this is a bond, a pure bond, a straight bond, no embedded feature, is a debt instrument. But in a convertible bond, there is an option to convert into equity share. So basically you are giving a call option to the holder of the instrument, which gives him a right to acquire the equity share of the company. Is it right? So that means that instrument will be settled in the form of equity share of the entity. So that portion becomes equity instrument. So what is the objective of discussing compound instrument here? The accounting treatment of debt and equity is different. Once it is debt, then as per IFRS 9, you have to either account it at fair value through profit and loss account or at amortized cost. Is it right? Equity instruments are not subsequently remeasured. Equity instruments are not subsequently remeasured. Whatever is the value of equity we will identify will remain as it is till the instrument is either redeemed or converted. But the debt portion accounting will depend on whether it is FVTPL or amortized cost instrument. So this is one of the best example of substance over form. In form it is one instrument, but in substance there are two instruments. What we need to do? Guess. Separate the debt portion and equity portion. Then debt portion will be accounted depending upon its classification. Equity is not subsequently remeasured. Okay, that means whatever amount we'll identify right now will remain in the equity till this instrument is settled, redeemed, converted. Okay. A financial instrument may be structured such that it contains both equity and liability component. That is, the instrument is neither entirely a liability nor entirely an equity instrument. An example of compound instrument: a bond that is convertible either mandatorily or at the option of the holder into a fixed number of equity shares of the issuer is an example of compound instrument, because on one hand there is an obligation to pay cash, interest, principal. There is another option to convert into equity share. This option to convert into equity share is an equity feature. So the liability and equity component of a compound instrument will be accounted separately. But for that purpose we have to first split them. So one of the highly tested question in the CA exam and other professional exams. Okay, split accounting of compound instrument. A compound instrument takes the legal form of a single instrument. So while issuing it, we issue it as one instrument only. But in our financial statement, it will appear as two instruments. The liability part will appear in liability section and the equity part will appear in statement of changes in equity. Okay. Question now below is para 20. Why there is a need to split equity and financial liability component in a compound instrument? The answer is the accounting treatment of equity and debt instrument is different. Okay. Once you separate equity and debt, then the debt will be further accounted as per its classification, either FVTPL or amortized cost. An equity instrument is not subsequently remeasured. If you treat it as one instrument, even the equity portion will get accounted like debt portion only. Okay. So that is why they said you separate. The requirement to separate out the equity and financial liability component of a compound instrument is consistent with the principle that a financial instrument must be classified in accordance with its substance rather than the legal form. And accounting is also different. Now, how to separate them? So once again understand paragraph 21. Example: a convertible bond that pays fixed coupon and is convertible by the holder into fixed number of equity share of the issuer has a legal form of a debt contract. Contract is one. Company has issued this bond. I have invested. So how many contract we have signed? One. He is the issuer. I am the investor. But in substance, as an accountant, I will see there are two features in that. There is a financial liability to deliver cash. That is your coupon and principal, which exists as long as the bond is not converted. And there is a written call option granting the holder the right to convert the bond into a fixed number of ordinary shares of the company. So fixed for fixed test is there. Fixed amount will be converted into a fixed number of equity share. So that becomes an equity. So how do we split now? See, this is a most important paragraph right now for solving the questions. This is the total fair value of the instrument. Okay, suppose you have issued a convertible bond for $1 lakh. Okay. So what we will do, first we will find out the fair value of the liability component. First we'll find out the fair value of liability. How do you find out? Present value of future cash flow discounted at market rate. Normally in convertible bond, the coupon rate is much lower than the market rate. Why? Because investors are given one option to convert into equity share. So he has an advantage. After 5 years, if the market price of share zooms to 5 times, he'll make 5 times profit. So he has to sacrifice something, and that is a coupon. So market rate is 10%, coupon rate may be 5%. I will take 10%. So that will give me the liability component. The residual is the equity component. Normally equity component you'll get some positive value. Whatever questions that are printed there, every time we will get some positive value. What if the equity figure becomes negative? Then you take equity component as 0 only, if at all. So far it has never happened, but if it happens, then equity becomes 0. Okay. Then what about the transaction cost that will incur to issue this instrument? The transaction cost will be allocated over liability and equity component. In which ratio? Respective values. Suppose this comes to 90,000 and suppose this comes to 10,000, and transaction cost is 2,000 rupees to issue this bond. This 2,000 rupees we will apportion over the liability and equity in the ratio of 9:1. We'll solve one problem on this later. Okay. And what is the further treatment once you apportion? Suppose I apportion 1800 rupees here and I apportion 200 rupees here. Then the carrying amount of this liability component will become 90,000 minus 1800. Because transaction cost will be adjusted against the fair value or carrying amount. So it will become 88,200, and the equity amount will become 10,000 minus 200, that is 9,800. So this will be the initial carrying amount of debt and equity if transaction cost is also given, right, in this rough example. And then we'll take a proper exam question which will give you transaction cost and asking you to allocate it. Okay. Right now I'm not going into accounting part. Accounting will be in the next chapter. Although in 1 or 2 questions we'll do the accounting also, debit, credit, your favorite. But right now our focus is presentation. Now this we have written to simplify it for the student, what you will do, because one question you can definitely expect from compound instrument. Step 1 is calculate the cash outflow as per the contract, which could not be denied by the company. That means mandatory outflows. Now what about the redemption value? Will you consider redemption value also? If the redemption is, or if the conversion is at the option of the holder, now whether he converts or not, that is later, but for the purpose of calculation we will consider the redemption value if the option to convert is with the holder. So if you have some space, write down there. If the option to convert, have I written this line or not? If the option to convert is with the holder, then consider, you can write at the top, then consider, don't write on benches, then consider redemption value. if the option to convert is with the holder, then consider the redemption value also. Now you will complete the sentence. If the option to convert is with the company, then can the company deny the cash? Yes. Then do not consider the redemption value. So you want me to dictate or write? Dictate? Right. If the option to convert is with the entity, if the option to convert is with the entity, then do not consider the redemption value. Okay, it will make a huge impact on the answer because redemption value will be a big amount and your answer will change significantly, not just by few rupees but by several thousand lakhs crores of rupees depending upon the question. Second step is find out the market rate of interest. Which market rate of interest you will take? Suppose there is another company which has issued a similar debenture or a bond or a similar instrument. All features are same. All features are same, only one feature is different. This is a convertible bond and that is a non-convertible bond. Risk is same, maturity is same, credit rating is same. Take the rate of interest or YTM of that instrument, yield to maturity of that instrument. Is it right? That means had I issued the same bond without a conversion option, what rate of interest I would have offered to the investor? Is it right? So take the market rate of interest. As a student, this is always given to you. Okay. This is also called the effective rate of interest and is used for calculating the present value of future cash flow as computed in step number 1. So you'll get the present value now. In step 1, estimate the cash flow which cannot be denied by the company. Step 2, use market rate of interest on a similar non-convertible bond. Step 3, calculate the present value of these cash flows. Done. This becomes the present value of liability component. This becomes the present value of the liability component. And step number 4, equity is equal to total proceeds received minus financial liability. Total proceeds minus financial liability. So add on up to this calculation, do not consider transaction cost. Because if you deduct transaction cost right now only from the proceed, then it will not get allocated in the ratio of debt and equity. Up to this calculation, do not consider transaction cost. So first ignore transaction cost, do this calculation, then transaction cost will be a portion in the ratio of the amount allocated to liability and equity. Then the amount allocated to liability deduct from liability, the amount allocated to equity deduct from equity. Is it right? So this step number 1, 2, 3, 4. This will do on day 1. Is it right? And what is the journal entry we will pass here? Bank account debit, total proceed received. To debenture liability portion and to debenture equity portion, or any such name you can give to identify the equity and debenture portion. Okay. So this is called day 1 entry. In this chapter, we would normally be asked to pass entry only up to the day 1. Subsequent accounting will depend on the classification of debenture. Equity will not be done any further adjustment. Equity same figure will appear again and again till the conversion or redemption. But the debt accounting can be different depending upon the classification. So that we are not taking in detail in this topic, because we have not yet discussed accounting treatment of financial liability. Okay. Subsequent accounting of compound instrument. Today we'll discuss briefly, and then in the next chapter, IFRS 9, we will solve around 30-40 problems, so you'll understand better. So will be subsequently measured in accordance with measurement requirement of IFRS 9. I've written it in your notes. Depending upon its classification, either as a financial liability at FVTPL or as other liability measured at amortized cost using the effective interest rate method. So effective interest rate means IRR. Equity component will not be remeasured. Third point, no gain or loss arises from initial recognition of the component of instrument. Why no gain or loss arises? Total proceed is allocated between equity and debt. So there is no balancing figure here. First we will allocate to liability and all residual amount goes to equity. So no gain or loss on day one. If the holder exercises the conversion option, means the last year, if the holder exercises the conversion option, we have two accounts. Remember, one is liability account, equity account. So the liability account is derecognized. Debit the liability and credit the share capital. If the holder decides to receive cash, then first we'll pay him cash, liability to cash, liability account closed. If he exercises the option to receive equity share, liability to share capital. If he wants cash, liability to cash. So in both cases, how the liability account will close, you have understood. What about that equity account? That equity account, once the instrument is, you can say, derecognized, the balance in equity account is transferred to any other equity account, like for example, general reserve or retained earning. Okay. So in case some balance remains in that equity account, it will be transferred to another line item within the equity, but not through profit and loss. Not through profit and loss. So in one problem, I am going to take you to the last year also, where you will see how the accounts will close. But that is not actually part of this chapter. Is it right? Why equity component is the residual value? What is the definition of equity? Equity is the residual interest in the net asset of an enterprise. Equity is the residual interest in the net asset of an enterprise. That is the meaning of equity. So therefore, equity is taken as a residual value. Suppose a company is liquidated. Who gets the payment first? The debt holder. Who gets the residual cash? Equity. So using the same logic, while estimating the value of debt and equity in a compound instrument, debt will be valued first, equity will be always residual. Your question can be, can I first value equity and then debt is the balancing figure? A company issued debenture of 1 lakh convertible into equity share. The market value of equity share today is 90,000. Can I take 90,000 for equity and 10,000 I will allocate it to the debt? You cannot do that. You have to first calculate debt and then the equity would be the residual value. Okay. Now a long series of question answer will begin till the break time. Start. Is this question there? Yes, question number 18. Very important, a typical exam question. Entity A issues, solve in the book only. Entity A issues 2000 convertible bond on 1st January 20x5. The bond have a 3-year term and are issued at par with a face value of rupees 1000 per bond. 2000 into 1000, what is the total proceed? 2 million. They have written it also. So this is total proceed we have received. Interest is payable annually. Annually underline. After some time I'm going to take half yearly problem also. In arrears at an annual interest rate of 6%. This is coupon rate. This is what you will pay to the investor. Each bond is convertible. Double underline, at the holder's discretion. At whose discretion? Holder's discretion. So will you consider the redemption value also? Yes. At any time up to maturity into 250 ordinary shares. So fixed number of share will be issued. When the bonds are issued, the market interest rate for similar debt, but without conversion option, is 9%. So that we will call market interest rate for similar bonds with the same credit standing, having no conversion rights. Being a compound financial instrument, you are asked to separate the debt and equity portion. So how will you solve? First, we'll identify cash flows which cannot be denied by the company. So for 3 years you have to pay coupon 2 million into 6%, 1,20,000 for 3 years. Option is with the holder. He may demand cash. So at the end of year 3, I may be required to pay 2 million also. If he demands cash, I have no option but to pay him the cash. So this cannot be denied by the company. So consider that also. So write down, we will follow this format in all question. Calculation of financial liability and equity, it is written year cash flow discounting factor. Which factor you will take, 6 or 9? Take 9%. Okay. Then year 1 to 3, what will you write? 6% of 2 million means 20 lakh. Is it 1,20,000? And then year 3, you will have to pay 20 lakh. Okay. Can you tell me the factor for 9% and 3-year annuity factor? 2.53. Okay. Is it right? And year 3 only 0.7722. Very good. Multiply 1,20,000 into 2.5313. 3,03,755 approximately. No problem. Last digit may be different, no problem. 20 lakh into 0.7722. 15,44,400. Okay. 400, 360 is okay. Approximately last 3 digits can be different. Now total of this present value of cash inflow 1848 1 approximately. I'm writing approximately, your answer can be slightly different. No problem. What is this? This you write there, financial liability equal to. Okay. I have written it for you. Equity equal to total proceed minus financial liability. So how much is total proceed? 20 lakh, 2 million minus 1,848,155. Whatever amount you have written here, you write here. So the difference is how much? 1 lakh? 51,845. This is the value of equity. Okay. And then on the first day, you will pass the entry cash account debit 20 lakh. This is what is your proceed. To financial liability 18 lakh, how much? 48, 150, and equity 1 lakh 51, 845. Okay, this will appear in your liability and this will appear in your statement of changes in equity. It will affect your debt equity ratios. Earlier we used to transfer entire 20 lakh to debt. Okay, when you are in 12th standard accounting batch. But now you will use a different number. Question number next. 19. Entity A issues a bond with a principal amount of $1 lakh. The holder of the bond has the right to convert the bond into share of entity A. On issuance, again, who has the option to convert? Holder. Entity A issues the bond and receives proceeds of $1 lakh. By discounting the principal and interest cash flow of the bond using interest rate for similar bond, but without an equity component, entity A determines that the fair value of the similar bond without any equity component would have been $91,000. So working note 1 they have already done for you. Present value table they have completed. They got 91,000. Therefore, the initial carrying amount of the liability component will be $91,000. Is it a question or an answer? The initial carrying amount of the equity component is computed as the difference between total proceed $1 lakh and initial carrying amount of liability $91,000. This way they don't ask in the exam. The initial carrying amount of the equity component is $9,000. Even that they have written. This should have stopped there only, full stop. Then past journal entry. Only journal entry based on above. Entry is also written as a sample above. Only put the numbers. Cash account debit $1 lakh. To financial liability $91,000. To equity $9,000. That's it. This is the problem for warm-up exercise. After some time, I'll give you one question to try, same problem, and then we will see how many of you get it right. Okay. On 31st October 2000 X5, entity A issues convertible bond with a maturity of 5 years. The issue is for a total of 1000 convertible bond. Each bond has a par value of $1 lakh. A stated interest rate is 5% per year, convertible into 5,000 ordinary share of entity A. The convertible bonds are issued at par. Means they have received $1 lakh per instrument. Per share price for an entity A share is $15. Now this question I have kept it because it is to confuse the student. It's actually not required. Quotes for similar bonds issued by entity A but without conversion option is $90,000. Now this line is of no use. Students sometimes what they will do, they will take 5,000 share into 15. So I will assign 75,000 to equity and 25,000 to bond. Is it right? No. This ignore. 90,000 is the present value of a bond with similar feature without conversion option. Indicate how entity A should account for the compound instrument on initial recognition. Same question, same answer. Only this time, in order to confuse you, just to check whether you have read this chapter or not carefully, this extra information is given which is of no use. Equity will always be residual value. First you have to deduct the value of liability from the compound instrument. So entry will be same. Cash account debit $1 lakh. We are passing entry for just one instrument. Ultimately Or you can multiply by 1000. You want to multiply by 1000? No. Then write here figures in 1000. To financial liability 93,000 and to equity 10,000. Do not write equity 75,000 and liability 25,000 balancing figure. That will be wrong. Okay, after these three simple questions, now come to question number 21. Ready? On 1st April 2008, D Limited issued rupees 30 lakh 6% convertible debenture of the face value of rupees 100 per debenture at par. So what is the proceeds? 30 lakh. Amount received 30 lakh. Read carefully. It can be at a discount. It can be at a premium. Okay. The debentures are redeemable at a premium of 10%. Means the redemption value is 33 lakh. This time the redemption value we will take 33 lakh. On 31st March 12, student will count how many year the bond will be maturing in. 3 or 4? 4 year. Okay. Or this may be converted into ordinary share at the option of the holder. At the option of the holder. So you will consider that 33 lakh rupees which we discussed. But if it is at the option of the company, then you will not consider. That will take in another problem. The interest rate for equivalent debenture with conversion right is 10%. 6% is coupon rate, 10% is market rate. Being a compound financial instrument, you are required to separate equity and debt portion on 1st April 8. Present value factor for 6% is given, for 10% is given. Now this is again to confuse you. Which is not relevant in my answer? 6 is not relevant. You have to discount at market rate. When the problem gives you the factor, preferably use the same factor. Each of you will get the same answer. Although it is not mandatory, you can apply your own factor also. Okay. So my question is, what is the value of liability? Just try. Okay. So you answer first. How much is the cash flow you have written for 1-4 year? 1,80,000. And what is the year 4 redemption value? You will consider this. Redemption is at the option of, conversion is at the option of holder. What is the present value of 1,80,000 in the last column? 5 lakh? 70,000. And this figure? 22 lakh. Take the same factor which they have given. Okay, 0.68 and total of this 4. So this is called financial liability. How much is financial liability? 28 lakh. 14,000. So equity is equal to 30 lakh minus 28 lakh 14,600. 1 lakh 85,400. Sometime for this much efforts you will get 4 marks or 5 marks, 6 mark, 8 mark, depending upon demand and supply in the market. Now, how many of you think you are intelligent? All of you. Solve the next question. I am not going to even read the problem, because when I will read, you will understand the hint. 22 number. To test the intelligence of the student. Time allowed is 1 minute. Okay, you have done. Many of you are found struggling. The two questions look similar, but they are not same. On 1st April 2008, Sigma Limited issued 6% debenture of face value of rupees 100 per debenture at par. The debentures are redeemable at a premium of 10%. Same problem. On 31st March 12, again same problem, dates are also same. Or these may be converted into ordinary share at the option of the holder. The interest rate for similar debenture without conversion right is 10%. Being a compound financial instrument, you are required to separate equity and debt portion on 1/4/2008. Equity portion is rupees 1,85,400. Find out the debt portion. Find out the debt portion. The present value factor is given to you at 6%, 10%. Like previous problem, 6% is not relevant. Then, what is the answer for debt component? 28 lakh, 14,600. Are you answering from the previous question or this question? Previous question. You have solved it. A smart student can look at the previous problem. Everything is same, so the answer will also be same. So the answer is same. What you said, 28 lakh, 14,600. So how many of you got it right honestly on your own? My God. 6% result only. Write down the answer. You got it right. Let the face value of debenture issued be X. Let the total face value, total, not one instrument, total face value of debenture issued be X. Means proceeds. This will assume proceeds. Total proceeds is X. So take X as a base, take 100 rupees as a base. Any way you solve. And then draw the same format. Write down calculation of financial liability and equity. Same format. Year cash flow, present value, factor at 10%, present value. Then year 1 to 4. Now this time what is the coupon rate? 6%? 6% of X. How much? 6% of X is 0.06X. Correct? This is the coupon per annum you are paying. And in year 4 you are going to redeem at a premium of 10%. So you are going to pay not only X, X plus 10% of X. So 1.1X. 10% more, 1.1X. Now use the factor given in the question only. 3.17, 0.68. 3.17 if you add the factors at 10% discount rate. Now you multiply 0.06x into 3.17. 0.1902x. Now in this question we are doing reverse working. We know the answer equity. We have to find the proceed and debt. Multiply 1.10 into 0.68, 7.748x. Take total. This total will give you financial liability. How much is that? Add it carefully. 0.9382x. 0.9382x. Understood? So what is equity equal to? Total proceed minus financial liability. But one number we know. Equity amount we know in rupees terms. So I can now crack this equation. Equity is 185,400. Total proceed we have assumed X. Out of that liability is 0.9382x. So if I solve this equation, first I'll get total proceed. So total proceed is 30 lakh. Answer is not over. What is the question? What is the value of debt? This is total proceed. This is equity. What is the value of debt? Again, balancing figure. So therefore, the financial liability will be equal to total proceed minus equity. Okay, or you can solve this equation now and find the value of financial liability, or you can just put the value of X here and you can get the value of financial liability. 28,14,600. This way they can ask you the question. Okay. Okay, try one more question. Although it is written for homework, but we will solve it as classwork only. ASF Limited rupees issued rupees 1 crore worth of 8% debenture of face value rupees 100 each on par value basis on 1st January 2011. These debentures are redeemable at 12% premium at the end of 2014. So after how many years? 3 year or 4? 1st January 2011 and end of 2014. What is the number of years? 2 years. 2 square. Okay. 4 years. And redeemable at a premium of 12%. Redeemable at a premium of 12%. So 1 crore and plus 12% means 1 crore 12 lakh. Right? Or exchangeable for ordinary share of ASF Limited on 1:1 basis. The interest rate for similar debenture that do not carry conversion entitlement is 12%. You are required to calculate the value of debt portion out of the above compound financial instrument. So debt and equity again. Now one problem is there. Who has the option? Investor or the company? Previous 5 questions had clearly mentioned the holder has the option. But this time it is not clear. That is, debentures are redeemable at 12% or exchangeable for ordinary share on 1:1 basis. If the problem is not clear exactly, assume the holder has the option. Assume the holder has the option. And if the holder has an option, then you will consider the redemption value also. I don't have the answer of this question. You have to solve and give me the answer. So let us see who will give the answer first and correct. Direct question, no equation. Solve there only. Draw the format neatly. Bring a scale every day. I have given you the format. Write cash flows first properly. After writing cash flow, then use the discounting factor at 12%. 10% was previous question. Some of you are still in the 10% mode. And bring calculator also. One calculator used by 2 students. What a poverty. Okay, time over. What is the answer? 4 lakh 52,000. That's it. Equity. Oh, I thought 1 crore rupees is the value and the debt component is 4 lakh. So tell me, how many years are involved? 4 years. What is the cash flow you have written here? 8 lakh you have written. And year 4, what is the cash flow you have written? 1 crore 12 lakh. 1.12 cr. Discounting factor at 12% for 4 year. How much you have got? 3.0373. And fourth year, how much you got? 0.6355. Okay, now tell me the answer in the last column. Answer 24 lakh 840. 840 approximately. 2 rupees 5 rupees difference is okay. And this into this 71 lakh 70,000 600. This is 17. Okay, 95 lakh 47,000 440. 440. Now write down equity equal to proceeds minus liability. Proceed is 1 crore minus 9547440 approximately. So this will be 4 lakh 52,560, right? Approximately. If you use a different factor, your answer will change here by few rupees. Okay, don't worry. Done. Okay, come to next question. 24. ASF Limited has issued 5,000 convertible debenture with a face value of rupees 100 per debenture. So what is the total value of debenture issued? Is it 50 lakh? 5 lakh. Is it 5 lakh? Okay. The interest rate on the debenture is 5%. Debenture holder have the option of converting into shares at the end of 4 years. Prevailing market rate for similar debt which does not have a conversion right is 7%. The question is same. Find out the equity and debt portion. Find out the equity and debt portion. Again, classwork. Try fast. Don't sit idle. Try. Don't sit. Come on. Write the heading. Some student have directly written the answer only here. Calculator they took, multiplied, factor into cash flow, memory plus, again factor into cash flow, memory plus, memory recall, answer. That is also okay, but in the class. What is the cash flow you have written for 1-4 year? 25,000? Okay. Wait a minute. 25,000. And what is the redemption value you have written? 5 lakh. Now tell me 25,000 into what is the factor you have written? 3.3872? Multiply 84. Okay. 5 lakh into 0.67628, 381450 approximately. So what is the financial liability you got? 466130. So what is the amount of equity here? 5 lakh minus 466130. How much is that? 33870. One more question you will try. Those who think you are intelligent, time to test your intelligence. This is question number 25. Is it there? Yes. 8 mark question. 8 mark minimum. I will not read the problem also. So let us see how many of you get it right. Those who will get it right, they will pass the exam with certainty. So today only your financial reporting results are out if you can get it right. Okay, time over. I give you 5 minutes to try your luck. What is the answer? Value of debt 19 lakh 85,935. Okay, and remaining is equity. Okay, let us try. At the beginning of year 1, enterprise issued 20,000 convertible debenture with a face value of rupees 100 per debenture at par. The debenture of 6-year term, interest is 9%, paid half yearly. Bondholder have an option to convert half of the face value of debenture into two ordinary share at the end of year 3. The bondholder not exercising the conversion option will be repaid at par to the extent of rupees 50 per debenture at the end of year 3. So for the purpose of calculating the liability, you will assume cash will be paid here. You will assume cash will be paid. The non-convertible portion will be repaid at 10% premium at the end of year 6. At the time of issue, the prevailing market rate for similar debt without conversion is 10% discount rate. Find the value of debt and equity. This is a semi-annual coupon paying bond. What is the life of this bond? 6 years. But if it is a semi-annual coupon paying bond, then we'll take 12 half years. For all calculation purpose, now assume it is a 12 half year problem. One period consists of 6 months. So there are 12 half year period. Second thing, that if the coupon rate is 9%, then half yearly coupon will be 4.5%. And if the discount rate is 10% for a year, it will be 5% 6 monthly. 5% for 6 months. So you treat this problem like this. There are 12 periods, coupon rate 4.5% and discount rate 5%. For all calculation, these numbers will be taken. Okay. And then what you will do, after 3 years, there is a redemption also. How much is the redemption value? 10 lakh. 20,000 into 100 into 50%, or just 20,000 into 50. 10 lakh rupees you will have to take as redemption. So your interest calculation after the 6th half year will change. First it will be based on 20 lakh and then it will be based on 10 lakh. And then in the last year there is a redemption also at 10% premium. 10% premium means how much amount will be paid here? 10 lakh is outstanding and plus 1 lakh. So 11 lakh will be paid here. So once you are able to identify the cash flows which company cannot avoid, then you discount it. Okay, presentation can change, but the final answer will be approximately the same. Approximately, because factors can be different here. So those who have not done, now write. First column write. Either you can write year or period. One period is equal to 6 months. Particular cash flow. Now careful here. Don't take 10. Take 5%. Take 5%. Is it right? And then present value. Then present value. So first 1-6. There is no problem. 1-6. Every year same interest will be paid. How much? Write, those who want to write calculation, 20,000 into 100, that is 20 lakh, into 9% into 6 by 12. Or you can just write 20 lakh into 4.5%. Calculation must be shown in case of such problem. 90,000. Anybody who took the annuity factor for 6 period and 5% combination? Is it around 5.0757? Multiply 456,813 approximately. Then in the sixth year, there is one more outflow. Option is with the holder. So if he demands cash, you have no alternative but to make the payment in cash. So repayment 20,000 debenture into 50 rupees. 10 lakh. Write 10 lakh properly. And then factor for sixth period at 5%. 0.7462. Multiply 746200. Then again for next 6 periods, 7 to 12, you will pay interest. Half of this number because half is redeemed. So 20,000 into 50 rupees into 9% into 6 by 12. This is 45,000. Anybody who could calculate the factor for 7-12? 3.7876. All of you know how to get it? Yes or no? 1,70,442. Then 12th period. Everything will be treated as half yearly. Student can ask this question, can I take 6 year here and the factor at 10%? All cash flows will be compounded half yearly, including the redemption value. Is it right? Same interest rate with same frequency is used for all cash flows in the same problem. So redemption value is 10% premium. 10 lakh plus 1 lakh. 11 lakh. Factor. Check factor 0.5568. 612,480. Total of the last column is your financial liability. These cash flows cannot be avoided by the company. So 1985,935 approximately. Honestly answer, I will not say anything. Who got it right? Just this much. Wrong. Right. Okay. This time the result was better than previous time. 8% result. Equity is equal to total proceed minus financial liability. So total proceed was how much? 20 lakh. I think I have written, yes. Minus the previous answer, 14065. Okay. We'll try one more. In all this question that we solved till now, till 25 number, the option was with the holder. Now we'll solve a question. Option is with the entity or it is a mandatory conversion. Either it is an option with the entity or it is a mandatory conversion. So if it is a mandatory conversion, again cash is not required to be paid. So we'll not take the redemption value. Read the problem. On 1/4/2008, A Limited issued 8% debenture of rupees 12 lakh. These are redeemable at 10% premium or to be converted into equity share at the choice of the company. I have already underlined it for you, at the choice of the company. Means if the company wishes to avoid cash payment, it can do so. It has a power not to pay the cash. It can simply convert into share. So I will not take this redemption value. This is to confuse you. 10% premium. Rate of interest on a non-compound financial instrument is 14%. Calculate the value of equity and debt. Alternatively, the same question in another exam was asked like this. Same problem. So we will not solve two times. On 1/4/2008, A Limited issued 8% debenture of 12 lakh. And then they have written these are mandatorily convertible into equity share on 31st March 12. So instead of writing convertible at the choice of company, the question can be mandatorily convertible on 31st March 12 or 11. Rate of interest is 14% on a similar non-compound instrument. Value of debt and equity you have to find. Now how many years are involved here? 3 year or 4 year? 8, 9, 10, 11. Okay, 8, 9, 9, 10. 10, 11. 3 years are involved. Solve. Calculation of financial liability and equity. Year cash flow. What is the market rate of interest? 14%. 14%. Present value. You can either write in a single line also 1-3, because cash flows are same, 8% of 12 lakh. Or you want to write separately, you can write. Choice is with you. Why this time we have not written the redemption value? Either it is a mandatory redemption, mandatory conversion, or the choice is with the company. So company can avoid the payment in cash. Just take the calculation, bring good calculator. Huh? 222, 884 is right. And then I have written a note so that later on you don't ask this query that why redemption value is not considered. So just to remind you, write a note. Remember, redemption value is not considered because the redemption option is with the company. Because the redemption option is with the company. The company can deny the redemption in cash. The company can deny redemption in cash. The company can deny the redemption in cash. The answer is not over. Equity equal to total proceeds minus financial liability. Total proceeds minus financial liability. Total proceed is how much? 12 lakh. Financial liability, this number. What you have got it in first answer? Write it here. Difference 977 116 approximately. Done. Try this question now. ASF Limited issued 9% convertible debenture of 7 lakh. Now this time what they have done? At 10% discount. So my proceed will be 7 lakh minus 10%. 6 lakh 30,000. 6 lakh 30,000 is the proceeds. Remaining discussion is same on 1/4/2008, convertible on 31st March 2011. These are to be converted at 10% premium. Rate of discount on similar non-convertible debenture is 13%. Calculate debt and equity. Do we have to redeem in cash or do we have to convert into share? No, read the problem. Is it a mandatorily convertible debenture or optionally convertible debenture? It's written these are to be converted. What do you mean by these are to be converted? I will say you have to take a break. Is it optional? Now you understood. These are to be converted means mandatory. So 10% premium is the equity share that will be issued will be 10% more than this value. Discount rate is 13%. Calculate first proceed. Calculate first proceed. 7 lakh minus 10% discount, or you can do it later if you want. 6 lakh 30,000. Be careful with the question. This time it is at discount. Okay. calculation of financial liability, we will only consider the coupons. 3 times coupons will be paid. That cannot be denied by the company. Then what is this 63,000? 9% of 7 lakh. Not 9% of 6,30,000. Then this is 2.3612. Just check, is it right? And present value is approximately 148,756. This is my proceed. This is the liability. So what is the remaining amount? 481,244 equity. 481,244 is equity. Are you getting? These are the questions they have asked in the exams for 5 to 8 marks. Now write down journal entry on initial recognition. Journal entry on initial recognition. Bank account debit 6,30,000. There is no entry for discount. Discount has gone in bank account only. Is it right? In basic accounts, they used to teach us bank account debit, discount account debit, to debenture account. Those days are over. There is no discount account I am going to open. Is it right? Whatever you have received will be allocated between debenture and equity. So to debenture financial liability 148,756 and to equity 481,244. Now you are wondering why we have given one full blank page. Write one more question there. Prepare ledger accounts. Prepare ledger accounts. Although that is not a part of this chapter, but we will see how the accounts will close. Okay, how the accounts will close. So we are actually using the information from IFRS 9 because further accounting is covered by IFRS 9. In IFRS 9, there are two types of financial liabilities. One which is carried at amortized cost and one is carried at fair value through profit and loss account. So this instrument will be carried at amortized cost. Okay. So we will use effective interest rate method for accounting purpose. So write down. First you draw this format. Step 5. Debenture financial liability account. Or you can write in notebook if you don't have enough space there. As you wish. Bring a notebook also. Buy back, borrow or still but get it. First write down on the credit side. This computer is moving on its own. Okay. First let it do its activity. 3-year problem. Year particular amount, year particular amount. First entry will be, you have written the entry bank account debit to debenture financial liability and to equity account. So this is that first entry by bank 148,743. Is it right? We are going to calculate interest on this amount. This is what interest actually we are going to recognize in the profit and loss. So by interest, opening balance of liability into effective interest rate. Opening balance of liability into effective interest rate 13%. That means we are passing an entry interest account debit to debenture financial liability account being interest accrued. Okay. Check the answer 19337. And when you will make the payment, the entry will be debenture financial liability account debit to bank. Okay, to bank 63,000. This is called amortized cost method or effective interest rate method. Interest is accounted on opening balance multiplied by effective rate of interest. Payment made is deducted from the liability. To balance carried down 1,05,080. Next year, right, year 2, buy balance brought down 1,05,080. Buy interest on opening balance at 13%. 13660. 13660. This interest will be transferred to profit and loss. And then to bank 63,000. That is the coupon payment. To balance carried down. Check the answer. 55,740. Third year, be careful. In third year, the account should close because I have paid my obligations. So buy balance brought down first, write 55,740. To bank 63,000 write down. And buy interest balancing figure. If you take 13% of this number, it may be slightly different from this number. Just check 13% of 55,740. 7246. So you round it off so that this account will close. You paid your obligations. Your liability account should close. And how will you prepare equity account? Equity is not remeasured. First year you will write in equity account buy bank, that figure which you have written, to balance carried down. Buy balance brought down, to balance carried down. Buy balance brought down, and in third year you are going to issue equity instrument. So to share capital. If there is a difference, it will be adjusted in any component of equity only. Okay. So let us write equity account also. Directly I am coming to third year. First year will be just buy bank on the credit side, that amount you have written in the beginning, and to balance carried down, and then it repeats. Second year, opening balance, closing balance. Third year, the entry will be buy balance brought down 481 257. First and second year only opening closing balance. Equity is not remeasured. And then after writing this, you write down to equity share capital account. To equity share capital account. $770,000. They had mentioned that redemption is at 10% premium. And buy reserve and surplus. So this balancing figure will be adjusted in some equity account. $288,743. Okay. Now we will take a break.